Hello learners, and welcome to the Business Data Analytics session. I am your illustrator, Nicholas Sikali. Today, we are going to tackle a question on the statement of cash flows and see how we can be able to solve a question on the statement of cash flows using Excel. The question that we are going to use is the one that was brought by KASNEB through its pilot paper that was released recently. A sample of the pilot paper is what we have before us here. So I'll be opening a sample of the pilot paper so that we can see how it looks like and how your questions are going to look like. So this is the pilot paper, a sample that was just released the other day. The pilot paper for Business Data Analytics, which is a practical paper, consists of two sections. We have section 1, which has a total of 40 marks, and it is tested through multiple choices, because in this section, students are required to pick the correct choice from the given multiple choices. Now we also have section 2. Section 2, which is a total of 60 marks, is where now you'll be required to solve much of these questions using Excel. Like there is question 21, which you are required to prepare a spreadsheet showing a forecast statement of profit or loss, of course, for the next 3 years under the scenarios that have been given here. So this is a sample of how you can be able to prepare such a forecast of the statement of profit or loss, of course, using the rates given. Then we had question 22, that is the Rubini Limited, where students were required to prepare a statement of cash flows, of course, for the years ended 30th June 2021 and 30th June 2022, still using Excel. Then there was question 23, where you are required to apply your financial management knowledge to be able to solve this question here. Of course, it has aspects of net present value, discounting rates, and all those other items. Today, we are going to solve the question on a statement of cash flows. This is question 22, where it's reading, you are provided with the following extracts of the statement of profit and loss and the statement of financial position for the Rubini Limited for the years ended 30th June 2020, 2021, and 2022. Of course, this is the statement of profit or loss extract for the 3 years. Then we have the statement of financial position as well for the 3 years. Then you have the required, prepare the statement of cash flows for the company for the 2 years ended 30th June 2021 and 30th June 2022. Of course, to be able to do this particular question, especially part A on the statement of cash flows, we will export or convert this PDF file to Excel. So I'll be able to provide or convert this particular file to Excel using the tools that are available. And once converted to Excel, we will be able now to solve it. So here it is. I've pulled the same question. That is the Rubini Limited statement of profit or loss extract for the years ended 30th June, of course 2020, 2021, and 2022. This is the exact question that I've pulled from the PDF format. Now it is in the format of Excel. And having gone through it, we have required prepare the statement of cash flows for the 2 years ended 30th June 2021 and 30th June 2022. Of course, all that gives you total of 8 marks. Your knowledge of preparing the statement of cash flows has it that there are 2 methods of preparing the statement of cash flows. We have the indirect method, and we also have the direct method. Remember, the indirect method is where you are required to adjust your profits, of course, your bookkeeping profit, for the effects of those items which are not cash in nature, like depreciation, amortization, and impairment. You also adjust that for the items or transactions which are not operating activity, things like gain or losses from the sale of non-current asset. And we also adjust it for the effect of accruals. So if there is any accrued expense, you're also supposed to adjust for it for you to be able to get cash generated from operating activity. Then we have the direct method of preparing the statement of cash flows. The direct method is used where all the information that will enable you to get the gross cash receipts and gross cash expenditures or payments, of course, those methods of getting such things have been provided. Now, in our question here, we can be able to use both direct method and indirect method, but I'll go straight and use the indirect method of preparing the statement of cash flows. So cash flows are categorized into three. We have cash flows from operating activities, we have cash flows from investing activities, and finally we have cash flows from financing activities. So we are going to start with cash flows. Cash flows from operating activities. Cash flows from operating activities. That is the first heading of cash flows here, from operating activities. I'll, of course, make that bold, and I'll also underline that. I'll bring the currencies, or before the currencies, I can be able to bring the years. They said 2021. I'll also bring the other one, that is 2022 as the year. I'll also bring 2022 that way. Maybe I can center that it is well centered like that. Perhaps this could be here, this way, so that I bring the currencies for those respective years that way. This one can also be made to be bold. Then our cash flows from operating activities. For you to be able to get cash flows from operating activities using the indirect method, then it means that we can use any of the profits here. You can start with the operating profit, that is profit before interest and tax if you want. You can start with the profit, this is profit before interest and tax. There is profit before tax. There is also net profit. There are four profits here that you can be able to use. There is net profit, there is profit before tax, there is profit before interest and tax, and if you so wish, you can even start with operating profit. So depending on the profit that you start with, of course, that is what will really matter when making adjustments here. Like if you start with operating profit, then there will be no need of making adjustments for depreciation, which we see here. If you start with profit before interest and tax, then of course you must adjust for depreciation. And of course, when you start with the net profit that is below here, then it means you also adjust for so many items there. So I'll pick profit before interest and tax. Profit before interest and tax there. I'll not make it bold. So profit before interest and tax, in this particular case, this one for 2021, profit before interest and tax for 2021 is that. Then we also have profit before interest and tax for 2022 is this. So Control V there. So Control V, so that is profit before interest and tax. Once we have profit before interest and tax, of course, we will add back. What can we add back? Profit before interest and tax, we'll add back depreciation. So depreciation was given as 800 and 750. So I'll be adding back depreciation. So add back depreciation. Add back depreciation. Of course, this one is not to be bold. This one is not to be underlined. So depreciation is 800 and 750. So I'll use 800 here. And I'll use 750 there. And 750. So it's supposed to be in bracket. So I'll adjust this. More number formats. I'll go to custom, scroll down, and find the one that is exactly showing that, which is here. I'll click on it, and of course you can see it's in bracket now. So you add back depreciation. You check for any other thing to add back. If at all given in the additional information, there was nothing like that. Of course, for profit before interest and tax, it means finance cost is yet to be deducted. Tax expense is also yet to be deducted. So you won't adjust for those. Then this will give you operating profit. Operating profit before working capital changes. Operating profit before working capital changes. That will be given by this. I think something is wrong somewhere. We are adding back depreciation. So that is 800. And this one is 750. So yeah, 750. So that you get equal sign. So we are adding it back because it had been deducted before arriving at profit before interest and tax. So remember, depreciation had been deducted, so you add it back. So this is that plus this. Get that. Then again, equal sign, this plus 750. And it will give you your answer of 27,506. So that is profit, operating profit before working capital changes. Now we want to go to changes in working capital. When we talk about working capital, we are referring to inventory, we are referring to receivables, and we are referring to payables. So we are going to look at those items and see how they changed. For starting with the inventory, and you check 2020, 2021. So inventory here was 15, here it was 21,750. So that is the increase in inventory. So increase in inventory. When you talk about increase in inventory, that one is an outflow. When inventory increases, it means that you went and purchased inventory. So increase in inventory will be given by what we had here. You subtract this, then you'll get your increase in inventory, of course, which is an outflow. So that is increase in inventory. Here will be equal sign. Inventory increased from this minus 27,488. And of course, the increase in inventory there is 57,38. Of course, 57,38. So this will be there. It is fine that way. Then there is also receivable. It's also increasing. So we also have increase in receivable. Increase in receivables. So equal sign. Now receivables are increasing from this, cost minus this. So that is increase in receivables. On the other side, receivables is increasing from 8750, cost minus 15,460. And that one gives you that increase in receivables. Then we look at payables. Payables, they are also increasing. So increase in payables. Remember, increase in payables are inflows and not outflows. So increase in payables, it means you've received more money or you went and purchased goods on credit. So that one is treated as an inflow. It will be equal sign. Increase in payables. Now we use this minus this one. It's an inflow. The other one will be equal sign. Here minus this, and that one is increase in payables. So that becomes increase in payables there. After that, we will be getting the cash generated. Cash generated from operations. Cash generated from operations. Cash generated from operations. The spelling of operations looks wrong. That is cash generated from operations. Now on cash generated from operations, it will be the aggregate of what we have here. It's operating profit before working capital changes, plus increase in inventory, plus increase in receivables, plus increase in payables. You'll get your cash generated from operations. The same, equal sign this plus here plus here plus increase in payables. Of course, you get the cash generated from operations. So that is cash generated from operations. Once you have that, of course, we move to finance cost paid and also income tax expense paid. So finance cost paid and income tax expense paid. We check if at all there is any additional information that would affect that to necessitate a control account, but there is none. So finance cost paid, finance cost paid. So finance cost paid here will just be what we have here. Finance cost paid, let's use minus. So the finance cost paid is 7,000 here, 7,000. So you can as well just say equal sign 7,000, equal sign 7,000. The other side equal sign 9,000. So you can see equal sign 9,000, it takes this. So that is finance cost paid. What about income tax paid? Income tax paid. So the income tax paid, the same tune. There is this 43. Then again equal sign 5327. That gives you 5327. So that is income tax paid. This will give you the net cash flows from operating activities. Net cash flows from operating activities, which will be the aggregate of cash generated from operations plus finance cost paid plus income tax paid costs, and you get 2840. The other side, this is 16,389. You add 9,000. You add 52. Remember, the ones that are in bracket are outflows, so it will just deduct and give you the answer. So that is 2062. So that is net cash flows from operating activities. Net cash flows from operating activities. After that, we move to cash flows from financing activities, not financing but investing activities. From investing activities, cash flows from investing activities. And on cash flows from investing activities, of course, we'll be seeing the changes in property, plant, and equipment. Remember, this property, plant, and equipment can only be affected by three things. One, acquisition of new property, plant, and equipment. Two, revaluation of property, plant, and equipment. Three, a disposal of property, plant, and equipment. That is if the PPE has been stated at cost. But if the PPE has been stated at net book value, then depreciation as well will be affecting property, plant, and equipment. So what we have here, reported as PPE, I believe is at net book value, and it will as well be affected with depreciation. Now, the only change here that we are going to get on investing activity will be, of course, whether it's acquisition of property, plant, and equipment. We are going to see that. If this is the opening balance of property, plant, and equipment for 2020, then this is the closing balance, which has increased so immensely. You can see from 25,800 to 45,200. That can only tell you one thing. The business purchased new items of property, plant, and equipment. Remember, there is no revaluation. Under equity here, there is no revaluation. So there was no revaluation that was carried out. So the only thing that affected property, plant, and equipment must have been acquisition and depreciation. So it's acquisition and depreciation. So what we do for you to be able to get what was purchased is that you take balance at the end. Of course, balance at the end. On it, you will add depreciation that was charged. Depreciation that was charged. Then you deduct the balance at the beginning. That will give you what was purchased during the year as far as property, plant and equipment is concerned. So that is cash paid to acquire PPE, or you can write it in full, property, plant and equipment, to acquire property, plant and equipment. So the solution will be equal sign. You take the balance at the end, that is at the end of 2021, add depreciation that was charged during the year. It's better we choose this, same as this, yes, but I want to use this because this is what that will be, the one that will give us adding. If you use this, it will be subtracting, which is wrong because they are in bracket. So we'll be using 800. You add 800, so I've clicked on 800. You less balance of PPE at the beginning of the year, which is 25,800. So you click on 25,800. What remains here there is what was paid to acquire. That is the balance on the debit side of PPE account, which gives you 20,200. The same case as this, equal sign. The balance at the end of the year 2022 is 46,700. So you click on 46,700. Add depreciation charge for the year was 750. Then you less balance at the beginning of the year, which was 45,200. So we have 45,200 here. Then you enter. That gives you 2,250 as cash paid to acquire property, plant and equipment. But they're supposed to be outflows, of course. They're supposed to be outflows, so we'll find a way of making them outflows. Let's see. If we go to custom, click on OK, it's still not bringing. So we will find a way of having that. The answer was, let me move back. You can see the answer is 2,200 and 2,250. So 2,200 and 2,250. 2,200 and 2,250. 2,200 and 2,250. So this is 2,250 because it's an outflow. This one should be 2,200. It was 2,200, I believe. 2,200. Let me confirm. Must have been 2,200. Yeah, 2,200. So this one is also 2,200. So it needs to be in bracket because it's an outflow, 2,200 and 2,250. So I believe you've seen how we got 2,200 and 2,250. Now there is no any other investing activity apart from that. There are no other non-current asset that we can use. So we'll be getting net cash flows from investing activities, net cash flows from investing activities. Of course, the same answer that we have here. The same answer that we have here, net cash flows from operating activities. I want this bold because it's such a major heading. Then finally, cash flows from financing activities, cash flows from financing activities, cash flows from financing activities. Now on cash flows from financing activities, you will be looking at the long-term borrowings and you'll be looking at the equity, how the equity changed, Now on long-term borrowing, you can see it's increasing. Long-term borrowing here is increasing. When it's increasing, it means it's an inflow. You borrowed more funds, so it's an inflow. So equal sign, that is increase in long-term borrowing, and it will be equal sign this minus the other one, because of course it's an inflow. The other one is also increase in long-term borrowing, 60,000 minus 46. That is also an increase in long-term borrowing. Then we go and check what happened in equity. Paid up capital remained the same, so it means that there was no change. Look at what happened in retained earnings. We want to assess and check whether there was dividend paid or not. Now look at this. There is retained earnings balance brought down of 70/80. Balance brought down of 70/80. Now on this balance brought down of 70/80, the balance carried down was 30/53. So we want to see how. Of course, 70/80, let's just see this one, 70/80. If you add profit for the year, remember there is profit for the year 2021 here. So you click on that, it gives you 30/53, which is the 30/53 that is here. So it means there was no dividend that was paid. So there will be no dividend. Let us also test the last one, equal sign. They started the profit of 30. They ended with a profit of 15,482. We want to see how. So balance brought down of 30/53. Add profit for the year of 12. There's a profit for the year of 12,429. Let's see if we'll get the 15 here. If you enter, the answer is 15,482. So that is fine. Again, there was no dividend that was paid. So it means this will be the only cash flows from financing activities. So that will be net cash flows from financing activities, net cash flows from financing activities, net cash flows from financing activities. Of course, it is the same answer that we have there, the same answer that we have here. The last part is to aggregate all the cash flows and get cash and cash equivalents. Cash and cash equivalents. That way. So cash and cash equivalents for the year is an aggregate of cash flows from operating activities, add cash flows from investing activities, add cash flows from financing activities. So equal sign 2840 plus 2200 plus 13334. So that is 4026. The other one, equal sign this plus that plus this. We will get 13145. Cash and cash equivalents brought down. Then we have cash and cash equivalents carried down. So cash and cash equivalents brought down, because that has been given, equal sign. The cash that you started with in 2021 was the cash that ended in 2020. So cash and cash equivalent here is 0. Add bank overdraft that was here, 5297. Of course, you get 5297, but it should be an overdraft. So equal sign 0 minus this. So it's an overdraft. The other one, equal sign 0 minus 9322. It's an overdraft of that one. Now cash and cash equivalents, when the period was ending, of course this will be equal sign this plus that. 9323. 9323 is the answer. Here you can see that cash at the end of the year, that is 2021. If you move down with the 2021, 0. Then this one is an overdraft of 9322. 93.22. So this and this should be the same. They should be the same. 93.22. This one is 93.23. So they are not. Equal sign. Let us test the other one. This plus this. That is 38.23. 38.23. 38.23. Let us confirm. It is an inflow. There is money. There is cash at the end of the year. 38.23. Look at cash. The overdraft is 0. The other amount is 38.23. So this is correct. 38.23. 38.23. You can see 38.23. 38.23. The other one is an overdraft of 93.22. Overdraft of 93.22. Here we got 93.23. So there's a difference of 1 for the cash flow that we've prepared for the year ended 30th June 2021. So this is how you are supposed to deal with this question on preparation of the statement of cash flows, of course, using Excel. The same thing that you know, but can you do it using Excel? That is the big question. Can you do the same thing using Excel? And if you can, then it means that you can be able to prepare a statement of cash flows. In our subsequent classes, we are going to look at other questions that were in that pilot paper, more specifically the question 21 on section 2, which required us to prepare a spreadsheet showing the forecast statement of profit or loss for the year, for the next 3 years under, of course, each of the 3 scenarios. But that will come later. For now, I would like you to comprehend this and see if you are able to repeat whatever happened here. Bye for now and see you in our next session.